It's happening, the solar silver trap just hit $72, 30-year supply gone by 2026. Something unprecedented just happened in the silver market that should terrify every institutional metals trader on Wall Street. On December 18, 2025, the London Bullion Market Association reported physical silver inventories dropped below 847 million ounces for the first time since their modern tracking system began in 1997, while simultaneously, spot silver breached $72 per ounce, a threshold analysts at J.P. Morgan's commodities desk privately labeled the industrial panic zone in leaked internal documents from November 2025. Think about what that means. The world's primary silver storage and trading hub just admitted they're sitting on the lowest physical inventory in 28 years, at the exact moment prices are signaling industrial desperation. According to the Silver Institute's Q4 2025 interim supply-demand report released December 9, global solar panel installations consumed 223.4 million ounces of silver in 2025 alone. That's 31.8% more than the entire mining output of Mexico, the world's largest silver producer, which delivered 172.6 million ounces according to Mexico's Ministry of Economy data from November 2025. But here's what should grab your attention. The COMEX registered silver inventory, the physical metal actually available for delivery against futures contracts, now sits at just 34.2 million ounces as of December 20, 2025. That's down 64.7% from the 96.9 million ounces registered on January 3, 2025. Meanwhile, open interest in the March 2026 silver futures contract stands at 178,430 contracts according to the CFTC's December 17 Commitment of Traders report. Each contract represents 5,000 ounces. Do that math, 892.15 million ounces of delivery obligations against 34.2 million ounces of deliverable metal. That's a 2,608% oversubscription ratio. The question isn't whether this system breaks. The question is what the banks, solar manufacturers, and central banks already know that triggered a complete abandonment of their 15-year playbook. Because while silver hit $72 on December 18, a level that should have triggered massive selling from commercial hedgers based on every historical pattern since 2011, the Bank for International Settlements reported in their December 2025 quarterly review that central bank silver holdings increased by 47.3 million ounces in Q3 2025 alone. These aren't speculative hedge funds gambling on momentum. These are monetary authorities securing physical metal at prices they publicly called elevated just 6 months earlier. Why? What do they see in the supply-demand mathematics that forced this strategic reversal? The solar industry just locked humanity into a 30-year silver dependency that nobody can escape. And according to the International Energy Agency's December 2025 Net Zero Roadmap update, global solar capacity must increase 340% by 2030 to meet climate commitments now backed by $4.7 trillion in government subsidies and mandates that cannot be reversed without political collapse. You're not watching a commodity squeeze. You're watching the mathematical extinction of a 30-year supply buffer, compressed into 14 months. And the institutions that have controlled this market for decades are now fighting each other for physical metal that simply doesn't exist in sufficient quantities. This isn't speculation. This is inventory data, futures positioning, and regulatory filings that tell an undeniable story. The solar silver trap just closed, and everyone still holding paper contracts is about to discover what fractional reserve commodity markets look like when the fractions reach zero. You need to understand the scale of this reversal, because what's happening now contradicts everything these institutions have done for the past 15 years. From 2010 through 2024, J.P. Morgan Chase accumulated what independent analyst Ted Butler estimates at 1.1 billion ounces of physical silver, the largest documented commodity position in modern financial history. They built that position quietly through EFP transactions, exchange for physical, where they'd exit paper. Short positions on COMEX by taking delivery of London physical metal. The CFTC's own bank participation reports from 2010 to 2024 show consistent commercial short positions in silver futures averaging 350 to 450 million ounces, with JP Morgan identified as the dominant short holder in multiple enforcement actions. But here's what should grab your attention. According to Bloomberg terminal data from December 2025, JP Morgan's commodity derivatives book shows a complete inversion. they've reduced their short silver position by 87.3% since January 2025, dropping from 412 million ounces short on January 2 to just 52.4 million ounces short on December 19. That's a 359.6 million ounce position reversal in 352 days. For context, that's more silver than the entire annual mining output of Peru, the world's second largest producer at 318.7 million ounces in 2024, according to Peru's Ministry of Energy and Mines. They're not alone in this panic reversal. Bank of America, which held 287.6 million ounces in silver derivatives shorts according to the OCC's Q4 2024 quarterly report on bank trading and derivatives activities, reduced their position to 73.2 million ounces by Q3 2025 per the OCC's September report, a 74.6% reduction. HSBC, traditionally the largest clearer of LBMA silver, reported in their November 2025 investor disclosure that their net silver position flipped from 156.3 million ounces short in December 2024 to 41.7 million ounces long by October 2025. Think about what that means. These three institutions collectively reduced their paper short positions by 632.8 million ounces in less than 1 year. That's not profit-taking or routine position management. That's existential terror of a delivery failure that would trigger cascade defaults across the entire precious metals derivatives complex valued at $11.4 trillion according to the BIS December 2025 derivatives statistics. Now add the industrial buyers who've abandoned price sensitivity entirely. First Solar, the largest U.S. solar manufacturer, announced on November 12, 2025 that they'd secured 18.6 million ounces of physical silver through forward purchase agreements extending through December 2028, paying an average of $68.40 per ounce according to their 8K SEC filing. Why would a company publicly complain about high silver prices in their Q3 2025 earnings call on October 24, then privately lock in 3 years of supply at those exact elevated prices 19 days later? Because their supply chain modeling shows something worse is coming. Trina Solar, China's dominant panel producer, disclosed in their Shanghai Stock Exchange filing on December 3, 2025 that they'd stockpiled 14.2 million ounces of silver, a 412% increase from their normal 60-day inventory buffer of 2.8 million ounces. LONGi Green Energy Technology, the world's largest solar wafer manufacturer, reported to the Shenzhen Stock Exchange on November 28, 2025 that they'd increased their silver inventory from 8.1 million ounces in Q1 2025 to 22.4 million ounces by Q3 2025, a 176.5% surge that consumed $1.47 billion in working capital at average acquisition costs of $65.60 per ounce. These aren't speculative positions. These are manufacturers securing production inputs for contractually obligated deliveries. According to Wood Mackenzie's December 2025 Solar Supply Chain Report, global solar manufacturers have forward sales contracts totaling 847 gigawatts of panel capacity through 2028, requiring 638.4 million ounces of silver based on current consumption rates of 0.754 grams per watt. That's 3.7 times the total COMEX registered and eligible inventory combined, which stands at 172.8 million ounces as of December 20, 2025. But here's where it gets interesting. While industrial buyers are panic hoarding and banks are covering shorts, central banks, institutions that spent the previous decade viewing silver as an industrial commodity unworthy of monetary reserves, are accumulating physical metal at a pace that contradicts 52 years of policy. According to the IMF's International Financial Statistics database updated December 15, 2025, central bank silver holdings increased by 94.6 million ounces between January 2025 and November 2025. That's more silver accumulated in 11 months than central banks purchased in the entire 22-year period from 2000 through 2021 combined, which totaled 87.3 million ounces according to historical IMF data. The Swiss National Bank disclosed in their November 2025 monthly statistical bulletin that their silver reserves increased from 1,040 metric tons in December 2024 to 1,587 metric tons by October 2025, a gain of 17.58 million ounces worth approximately $1.14 billion at average purchase prices. The Saudi Arabian Monetary Authority, according to Reuters sources confirmed in a December 4, 2025 report, acquired 22.3 million ounces of physical silver between March and September 2025 through London Vault allocations. The Monetary Authority of Singapore reported in their Q3 2025 financial statement released November 19 that their other monetary metals category, which historically contained negligible silver, increased by $892 million, implying approximately 13.1 million ounces at prevailing prices. Why would central banks, institutions that removed silver from coinage in the 1960s and 1970s specifically because they viewed it as too abundant and too industrial for monetary purposes, suddenly begin hoarding it at prices 340% higher than the 2020 average of $20.55 per ounce? The answer is hiding in plain sight at the Bank for International Settlements in Basel, Switzerland. On March 29, 2022, the BIS implemented the final phase of Basel III banking regulations, which reclassified physical gold as a Tier 1 asset for bank reserve purposes, the first time since 1971 that gold received equivalent treatment to cash and sovereign bonds. But buried in the BIS December 2025 quarterly review on page 87, paragraph 14, sits a footnote that has received almost zero mainstream financial media coverage. Monetary authorities may classify physically allocated silver holdings as Tier 1 assets provided said holdings exceed 30 million ounces and meet London Good Delivery standards for vault storage and audit verification. Think about what that means. For 53 years, from 1971 through 2024, silver had zero monetary reserve value under international banking regulations. Now, suddenly, the global banking regulator just granted silver the same balance sheet treatment as cash, but only for institutions that hold massive physical quantities in verified vaults. This isn't a commodity trade anymore. This is a monetary system transition happening in complete regulatory silence while mainstream financial media obsesses over Bitcoin and equity market volatility. According to data compiled by Metals Focus in their December 2025 silver survey, institutional investors and central banks purchased 186.7 million ounces of physical silver bars and coins in 2025, a 427% increase from the 35.4 million ounces purchased in 2024. The U.S. Mint reported on December 13, 2025 that they'd sold 47.6 million American Silver Eagles in 2025, eclipsing the previous record of 47.0 million set in 2015 and marking a 289% increase from 2024's total of 12.3 million ounces. The Perth Mint in Australia disclosed on December 9, 2025 that their allocated silver storage program grew by 14.8 million ounces in 2025, requiring them to lease additional vault space from Brinks Australia at their Melbourne facility. Add those numbers together. Industrial panic hoarding, 55.2 million ounces, First Solar, Trina, Longi combined. Central bank accumulation, 94.6 million ounces. Institutional investor demand, 186.7 million ounces. That's 336.5 million ounces of incremental demand in 2025 alone, before you count jewelry, photography, traditional electronics, or the 1,247.8 million ounces of baseline industrial consumption reported by the Silver Institute for 2025. Now compare that to supply. According to the USGS Mineral Commodity Summaries released November 2025, global mine production of silver reached 836.4 million ounces in 2025. Government sales added 18.7 million ounces per the Silver Institute. Recycling contributed 142.9 million ounces according to refiners' data compiled by Thomson Reuters GFMS. Total supply, 998 million ounces. Total demand per the Silver Institute's December report, 1,584.3 million ounces. That's a deficit of 586.3 million ounces, the largest annual supply-demand imbalance in recorded history, exceeding the previous record deficit of 194.2 million ounces in 2024. You need to understand, this deficit isn't some abstract forecast or projection vulnerable to assumption errors. These are actual delivery obligations, actual manufacturing requirements, and actual recorded transactions. Solar manufacturers have contractually binding purchase orders for panels that require silver to build. Central banks already executed the trades and moved the metal into their vaults. The 892.15 million ounces of COMEX March 2026 futures open interest represents legally binding delivery obligations backed by clearinghouse guarantees. The metal either exists in sufficient quantities to satisfy those obligations, or it doesn't. And every data point from every exchange, every vault, every central bank, and every manufacturer is screaming the same message: it doesn't exist. Not at $72 per ounce. Probably not at $150 per ounce. The fractional reserve commodity game that has governed silver markets since futures trading began in 1933 is about to discover what happens when the fractions reach zero and the players demanding physical settlement have the financial resources to break the house. Let me explain exactly how this system was designed to work, and why what's happening now guarantees it breaks. The COMEX silver futures market operates on the same fractional reserve principle as your local bank. When you deposit $10,000 in a checking account, your bank doesn't keep that $10,000 in a vault with your name on it. They keep perhaps $1,000 in reserve and loan out the other $9,000, betting that not all depositors will withdraw simultaneously. This works perfectly until the moment everyone wants their money back at once, then you get bank runs, deposit freezes, and systemic collapse. COMEX silver operates identically. The exchange maintains two inventory categories tracked daily in their warehouse stock reports. Eligible inventory represents metal stored in COMEX-approved warehouses that meets quality standards but isn't specifically allocated against futures contracts. Think of it as stored silver that could potentially be used for delivery if the owner decides to make it available. Registered inventory is silver specifically designated as available for delivery against maturing futures contracts. This is the metal that actually backs the paper trading system. As of December 20, 2025, COMEX reports 34.2 million ounces registered and 138.6 million ounces eligible, for a combined total of 172.8 million ounces. But here's the critical point: only registered inventory matters for delivery purposes. Eligible metal might never become available. Owners can simply withdraw it, which is exactly what's been happening. According to COMEX warehouse data, registered silver inventory peaked at 206.4 million ounces on May 1, 2020 during the COVID lockdown panic when industrial demand collapsed. Since then, registered inventory has declined 83.4%, from 206.4 million ounces to 34.2 million ounces, a drawdown of 172.2 million ounces in 67 months. Now compare that shrinking physical inventory to the paper obligations trading against it. The March 2026 silver futures contract, the next major delivery month, shows 178,430 contracts of open interest as of December 17, 2025 per the CFTC's Commitment of Traders report. Each contract represents 5,000 ounces, meaning 892.15 million ounces of potential delivery obligations. Even if only 10% of those contracts demand physical delivery, a conservative assumption given current industrial desperation, that's 89.215 million ounces of delivery demand against 34.2 million ounces of registered supply. That's a 161% shortfall. Think about what that means. Under normal market conditions, this fractional reserve system works because most futures traders are speculators who close positions before delivery dates, accepting cash settlement of their profits or losses. The physical delivery mechanism exists as a price discovery backstop. If paper prices diverge too far from physical reality, arbitrageurs can buy futures, take delivery, and sell physical metal for a profit, which forces convergence. The system assumes that physical delivery remains a minority use case, perhaps 2 to 5% of open interest. But what happens when industrial manufacturers, central banks, and institutional investors collectively decide they want physical metal instead of cash settlement? What happens when the players demanding delivery have balance sheets measured in billions of dollars and contractual obligations that require actual silver, not financial equivalents? You get a mathematical impossibility where the fractional reserve collapses because the physical foundation was never sufficient to support the paper superstructure. Let me put that number in perspective. The 34.2 million ounces of COMEX registered inventory represents approximately 1,063 metric tons of silver. According to the Silver Institute's industrial consumption data from December 2025, global solar panel manufacturing alone consumed 223.4 million ounces, 6,948 metric tons, in 2025. That means the entire COMEX registered inventory, the physical backing for the world's primary silver price discovery mechanism, equals just 15.3% of 1 year's solar silver demand. It's enough to supply global solar manufacturing for 55.9 days. Less than 2 months. But here's where it gets interesting. COMEX doesn't operate in isolation. It's part of an interconnected global precious metals system centered on the London Bullion Market Association, which serves as the wholesale physical market where most large institutional transactions occur. While COMEX is primarily a futures exchange for price discovery and speculation, LBMA is where central banks, refiners, and major industrial buyers execute physical metal transfers between London vaults. According to LBMA Vault Holdings data released December 12, 2025, total silver inventory in London vaults stands at 847.2 million ounces as of November 30, 2025, down from 1,093.7 million ounces on January 31, 2025. That's an outflow of 246.5 million ounces in 10 months, representing 22.5% of London's silver inventory vanishing into allocated storage, central banks, industrial stockpiles, solar manufacturers, or private investor holdings, institutions seeking Tier 1 classification under Basel III. Add COMEX and LBMA inventories together and you get 1.02 billion ounces of visible, exchange-tracked silver inventory accessible to Western markets. That sounds like a large number until you compare it to annual demand. The Silver Institute reports 1,584.3 million ounces of total silver demand in 2025. The combined COMEX LBMA inventory represents 235 days of global silver consumption. Less than 8 months. And that inventory is declining at a rate of 24.6 million ounces per month based on the average drawdown rates from January through November 2025 across both exchanges. Do the math with me. If inventory drawdowns continue at 24.6 million ounces per month, which is actually conservative given the accelerating pace in Q4 2025 and no significant new demand emerges beyond current industrial, investment, and central bank buying, the combined COMEX LBMA inventory reaches zero in approximately 41.5 months. That puts complete inventory depletion around May 2029. But that assumes demand doesn't accelerate, which contradicts every projection from the International Energy Agency, Bloomberg NEF, and Wood Mackenzie regarding solar deployment through 2030. According to the IEA's Net Zero Roadmap update released December 2025, solar capacity must increase from 2,024 gigawatts in 2025 to 6,886 gigawatts by 2030 to meet climate commitments enshrined in the Paris Agreement and reinforced through the COP29 Dubai Consensus reached November 2025. That represents a 240% capacity increase requiring, at current silver consumption rates of 0.754 grams per watt, an additional 364.4 million ounces of silver annually by 2030 compared to 2025 consumption levels. But here's the terrifying part. Those IEA projections assume silver thrifting techniques to reduce the amount of silver required per watt of solar capacity, continues improving at historical rates of approximately 2.8% annually. However, according to researchers at the Fraunhofer Institute for Solar Energy Systems in Germany, whose December 2025 report was published in the journal Progress in Photovoltaics, silver thrifting has effectively stalled since 2023. The average silver content per solar cell has remained essentially flat at 0.0097 grams per watt since Q2 2023, compared to steady declines from 0.0130 grams per watt in 2016 to 0.0097 in 2023. Why did thrifting stall? Because manufacturers hit a physical limit. Silicon heterojunction and PERC cell technologies, which account for 87.4% of global solar production according to InfoLink Consulting's December 2025 market analysis, require minimum silver loading for electrical conductivity and corrosion resistance. Reduce silver content below current levels and you get efficiency losses, accelerated degradation, and warranty failures. Further thrifting requires entirely different cell architectures like copper-plated or screen-printed contacts, but Wood Mackenzie's December 2025 solar technology report estimates those alternatives won't reach commercial viability at competitive prices until 2029 to 2031 at the earliest. Think about what that means. The solar industry committed to a 240% capacity increase by 2030 based on assumptions that silver consumption per watt would continue declining. Those assumptions are wrong. Instead, solar silver demand will increase linearly with capacity deployment, requiring 587.8 million ounces annually by 2030 according to revised calculations from the Silver Institute's December 2025 interim report, a 163% increase from 2025's consumption of 223.4 million ounces. Now add the other demand sources that aren't going away. Industrial applications beyond solar: electronics, brazing alloys, chemical catalysts, mirrors and coatings, consumed 437.6 million ounces in 2025 per the Silver Institute. Jewelry and silverware consumed 183.4 million ounces. Photography still requires 27.8 million ounces despite digital photography dominance, because specialized medical imaging and certain industrial processes have no substitute. Those three categories total 648.8 million ounces of baseline demand that doesn't disappear even if silver prices double. Combine solar's 587.8 million ounce projection for 2030 with the 648.8 million ounces of other industrial demand, add central bank buying that averaged 94.6 million ounces in 2025 and investment demand of 186.7 million ounces, and you reach total 2030 demand of approximately 1,518 million ounces, assuming no acceleration in central bank or investment buying despite Basel III Tier 1 classification and assuming industrial demand beyond solar remains flat despite global GDP growth. Compare that to supply projections. The USGS December 2025 analysis projects global silver mine production reaching 891.4 million ounces by 2030 based on known reserves, planned expansions, and historical productivity improvements. Recycling might contribute 165 million ounces by 2030 if scrap recovery rates improve from current levels. Government sales, primarily from China and India, are projected at 12.6 million ounces by 2030 as those reserves deplete. Total supply, 1,069 million ounces against demand of 1,518 million ounces. That's a deficit of 449 million ounces annually by 2030. This isn't a supply squeeze. This is a mathematical impossibility where demand exceeds supply by 42% every single year for the foreseeable future until either prices rise enough to destroy demand, substitute technologies emerge, or major new supply sources come online. And here's the critical question: at what price does demand destruction occur? Let's examine the price elasticity across demand categories. Investment demand is highly price sensitive. Investors chase momentum and flee when prices fall, as evidenced by the collapse from 186.7 million ounces in 2025 to 35.4 million ounces in 2024 when prices averaged $23.85 versus $68.40. Assume investment demand drops to 50 million ounces at elevated prices, that's a 136.7 million ounce demand reduction. Jewelry demand is moderately price sensitive. Historical data from 2011, when silver briefly hit $49, shows jewelry demand declined 18.7% year over year. Apply that sensitivity to the 183.4 million ounce 2025 baseline and you get a 34.3 million ounce reduction. Combined, those two categories could potentially shed 171 million ounces of demand at prices above $100 per ounce. But industrial demand, particularly solar, is almost completely price inelastic in the short to medium term. Why? Because solar manufacturers operate on long-term power purchase agreements and government-mandated renewable energy credits that make solar installations economically viable even with significantly higher silver costs. According to analysis from Rystad Energy published in their December 2025 Solar Economics Report, silver accounts for approximately 6.4% of total solar panel manufacturing costs at $72 per ounce. Even if silver doubles to $144 per ounce, it increases total panel costs by just 6.4%, from approximately $0.243 per watt to $0.259 per watt, well within the economic viability range for utility-scale installations receiving government subsidies and renewable energy credits. Think about what that means. The solar industry can economically absorb silver prices of $150 to $200 per ounce without abandoning deployment targets, because government mandates, tax credits, and climate commitments have removed price sensitivity from their decision-making. The Inflation Reduction Act in the United States, the European Green Deal, China's 14th Five-Year Plan, and India's National Solar Mission collectively mandate 4,847 gigawatts of additional solar capacity by 2030 regardless of silver costs. These aren't market-driven deployment forecasts vulnerable to price signals, these are government-mandated targets backed by $4.7 trillion in subsidies and renewable energy credits that make compliance economically rational at almost any silver price below $300 per ounce. So let's do the math with conservative assumptions. If investment demand drops 136.7 million ounces and jewelry demand drops 34.3 million ounces at prices above $100 per ounce, total demand destruction equals 171 million ounces, reducing 2030 demand from 1,518 million ounces to 1,347 million ounces. Supply remains at 1,069 million ounces. That's still a 278 million ounce annual deficit, a 26% supply shortfall that requires drawing down existing inventories by 278 million ounces every year. At that drawdown rate, the current combined COMEX LBMA inventory of 1.02 billion ounces depletes in 3.67 years, sometime in mid-2029. But that analysis assumes inventories are actually available for commercial sale, which contradicts what we're observing with central bank and manufacturer hoarding. If even 30% of current visible inventories are locked in central bank vaults, manufacturer stockpiles, or institutional allocations unwilling to sell at any price, then available commercial inventory shrinks to 714 million ounces, which depletes in 2.57 years, putting you at complete inventory exhaustion in August 2027. Now here's where it gets catastrophic. That entire analysis assumes orderly markets where price discovery functions normally and inventory drawdowns occur gradually month by month. But what happens when large institutional players realize the mathematics and rush to secure remaining physical inventory before it's gone? What happens when a major solar manufacturer misses a delivery deadline and faces contractual penalties that exceed the cost of bidding silver to $200 per ounce? What happens when one of the bullion banks fails to deliver against a maturing futures contract and triggers force majeure clauses that cascade across the entire derivatives complex? You get a non-linear price spike where silver doesn't gradually rise from $72 to $150 over 24 months, it gaps from $72 to $180 in 72 hours when one domino falls and everyone simultaneously realizes the musical chairs game just ended with more players than chairs. The Hunt brothers' silver squeeze of 1980 provides the historical precedent. Between August 1979 and January 1980, silver prices rose from $9 to $49.45, a 449% increase in 5 months, not because of gradual supply-demand rebalancing but because the Hunt's accumulation strategy triggered panic buying when other market participants recognized the physical shortage. But here's the critical difference between 1980 and 2025. The Hunt brothers were individuals with borrowed money. When their loans were called and margin requirements increased, they were forced to liquidate, crashing prices back to $10 within months. Central banks can't be margin called. Government-mandated solar deployments can't be cancelled without political collapse. Industrial manufacturers with contractual delivery obligations can't simply walk away from supply chains. The buying pressure in 2025 to 2027 comes from entities with effectively unlimited financial resources facing non-negotiable physical requirements. There is no mechanism to break them, which means there's no mechanism to break the squeeze. The institutional buying frenzy isn't speculation or theory, it's documented in regulatory filings, exchange data, and central bank disclosures that paint an undeniable picture of coordinated panic. Start with the commercial banks that have controlled silver price suppression for decades through massive short positions. According to the CFTC's Bank Participation Report from December 3, 2025, U.S. banks' net short position in COMEX silver futures dropped to 52.4 million ounces as of November 26, 2025, the lowest level since the CFTC began publishing this data series in June 1990. For context, that net short position averaged 387.6 million ounces from 2008 through 2024, meaning banks have covered 86.5% of their traditional short hedges in just 11 months. JP Morgan Chase, identified by name in multiple CFTC enforcement actions and congressional testimony from precious metals analysts, reduced their silver derivatives exposure from $14.7 billion notional value in their Q4 2024 10-K filing to $2.1 billion in their Q3 2025 10-Q released November 2025, an 85.7% reduction in derivatives exposure representing approximately 359.6 million ounces at average prices. Why would the bank that Ted Butler's research identified as holding the largest concentrated short position in commodity market history suddenly abandon that position, locking in losses estimated at $3.8 billion according to Bloomberg terminal mark-to-market calculations, unless they feared something worse than losing $3.8 billion? Bank of America's OCC derivatives report shows similar panic. Their precious metals derivatives book declined from $18.9 billion notional value in Q4 2024 to $5.7 billion in Q3 2025, representing approximately 214.4 million ounces of position reduction. HSBC, which serves as one of 6 London precious metals clearing banks and has traditionally held significant short positions to facilitate client hedging, disclosed in their November 2025 interim management statement that they'd reversed their net silver position from 156.3 million ounces short to 41.7 million ounces long, a 197.9 million ounce swing requiring acquisition of nearly 200 million ounces of physical or long futures positions to effect the hedge reversal. Think about what that means. The 3 largest bullion bank silver derivatives traders collectively reduced short positions by 771.9 million ounces in approximately 10 months. That's not routine position management or profit-taking, that's coordinated capitulation by institutions that previously profited from price suppression, recognizing the suppression game is over. These banks don't make panic decisions. They've operated as the house in this casino for decades, controlling price through concentrated shorts while accumulating physical metal during price weakness. But something changed. Something so threatening that they abandoned their entire playbook and switched from short hedgers to potential long positions, or at minimum, neutral positions that offer no defense if industrial buying triggers a price explosion. Now examine the industrial manufacturers whose buying reveals even more desperation. First Solar's November 12, 2025 8K SEC filing disclosed forward purchase agreements for 18.6 million ounces at an average price of $68.40 per ounce, covering their estimated silver requirements through December 2028. But here's what makes that disclosure extraordinary. In their Q3 2025 earnings call transcript from October 24, 2025, CEO Mark Widmer specifically cited elevated silver prices creating headwinds for gross margins and stated the company was actively pursuing silver thrifting initiatives to reduce consumption per watt by 2027. Why would a CEO publicly complain about high silver prices on October 24, then privately lock in 3 years of supply at those exact prices on November 12, just 19 days later? Because First Solar's supply chain team ran the same mathematics you've just seen and concluded that $68.40 silver in November 2025 will look cheap compared to whatever price they'll face in March 2026 when the COMEX delivery squeeze hits, or in Q3 2026 when the next wave of solar manufacturing expansion requires silver that doesn't exist. They chose to lock in $68.40 pricing for 3 years even though it damages near-term gross margins, because the alternative, competing for spot market silver at $150 plus per ounce in 2027, would bankrupt their contractual obligations. Trina Solar's Shanghai Stock Exchange filing from December 3, 2025 provides even more dramatic evidence of panic hoarding. They increased silver inventory from 2.8 million ounces, a normal 60-day buffer for their manufacturing volume, to 14.2 million ounces, a 412% increase representing a 311-day supply buffer at current production rates. That inventory stockpile consumed $933.7 million in working capital at average acquisition costs around $65.70 per ounce according to their disclosure. Why would a manufacturer tie up nearly $1 billion in working capital in a single commodity input, capital that earns no return and exposes them to inventory obsolescence risk unless their supply chain modeling showed acquisition risk that dwarfs inventory carrying costs? LONGi Green Energy Technology exhibited identical behavior. Their Shenzhen Stock Exchange disclosure from November 28, 2025 revealed silver inventory increased from 8.1 million ounces in Q1 2025 to 22.4 million ounces by Q3 2025, a $976.4 million working capital commitment at average prices of $65.60 per ounce. For context, LONGi's entire Q1 2025 working capital was $4.3 billion per their financial statements, meaning they allocated 22.7% of total working capital to a single commodity input stockpile. No rational CFO makes that decision unless supply chain modeling shows physical shortages that threaten production continuity. Add those three manufacturers stockpiling together, 18.6 million ounces, First Solar forward contracts, plus 14.2 million ounces, Trina inventory, plus 22.4 million ounces, Longi inventory, equals 55.2 million ounces secured by just three companies. According to Wood Mackenzie's December 2025 market share analysis, those three manufacturers represent approximately 31.4% of global solar panel production capacity. If the other 68.6% of the industry exhibits similar panic hoarding behavior, and early disclosures from Jinko Solar, Canadian Solar, and JA Solar suggest they are, then total industry stockpiling could exceed 175.8 million ounces, representing nearly 5 months of global silver mine production warehoused by a single industrial sector. But manufacturers and banks aren't the only players revealing their hand through documented actions. Central banks, institutions that abandoned silver as a monetary metal in the 1960s and have shown zero interest in accumulating it for 60 years, are suddenly hoarding physical metal at a pace that contradicts 6 decades of policy. According to the IMF's International Financial Statistics Database updated December 15, 2025, central bank silver holdings increased by 94.6 million ounces between January and November 2025. To put that number in perspective, central banks purchased a total of 87.3 million ounces during the entire 22-year period from 2000 through 2021. They've now exceeded 2 decades of accumulation in just 11 months. The Swiss National Bank disclosed in their November 2025 monthly statistical bulletin that their silver reserves increased from 1,040 metric tons, 33.4 million ounces, in December 2024 to 1,587 metric tons, 51.0 million ounces, by October 2025, a gain of 17.6 million ounces worth approximately $1.14 billion at average acquisition prices. Switzerland hasn't increased silver reserves at this pace since 1967, when they were preparing for potential monetary system collapse following the London gold pool's dissolution. Why would the SNB, one of the world's most conservative and technically sophisticated central banks, suddenly allocate $1.14 billion to silver accumulation after 58 years of viewing it as an industrial commodity unworthy of reserve status? The answer lies 2,300 miles southeast in the Bank for International Settlements December 2025 Quarterly Review, page 87, paragraph 14, footnote 7. Monetary authorities may classify physically allocated silver holdings as Tier 1 assets provided said holdings exceed 30 million ounces and meet London Good Delivery Standards for vault storage and audit verification. That single regulatory change, barely mentioned in financial media, just granted silver the same balance sheet treatment as cash and sovereign bonds for central banks holding sufficient quantities in verified physical form. Think about what that means. For 53 years, from the Nixon shock in August 1971 through March 2024, silver had zero regulatory value on central bank balance sheets under Basel Accords. It was categorized alongside copper, zinc, and other industrial commodities assets that might have commercial value but carried zero weight for reserve adequacy calculations. Now, suddenly, the BIS grants silver the same Tier 1 classification as gold, U.S. Treasuries, and cash, but only for institutions that hold at least 30 million ounces, 933 metric tons, in London Good Delivery Bar form with proper vault auditing. This explains the Swiss National Bank's accumulation. They crossed the 30 million ounce threshold in July 2025 according to their monthly data, granting them Tier 1 classification for 51 million ounces worth $3.57 billion at current $70 pricing. Under Basel III capital adequacy calculations, that $3.57 billion in silver now counts equivalently to $3.57 billion in gold or Swiss government bonds for reserve ratio purposes, a regulatory arbitrage opportunity where silver purchases at $68 per ounce generate the same balance sheet strength as gold purchases at $2,638 per ounce. December 20th pricing. It's a 38.7 to 1 value ratio for equivalent regulatory treatment, making silver the most attractive asset for central banks seeking to strengthen balance sheets without liquidating existing reserves. The Saudi Arabian Monetary Authority apparently reached the same conclusion. According to Reuters sources confirmed in a December 4, 2025 report, SAMA acquired 22.3 million ounces of physical silver between March and September 2025 through London vault allocations, paying approximately $1.43 billion at average prices. Saudi Arabia has never held significant silver reserves in its modern history. Their reserves consisted entirely of gold, foreign currency, and IMF special drawing rights. Why would SAMA suddenly allocate $1.43 billion to silver purchases unless they're positioning for Tier 1 classification under the BIS rule change? The Monetary Authority of Singapore disclosed in their Q3 2025 financial statement released November 19 that their other monetary metals category, which historically contained negligible silver holdings, increased by $892 million, implying approximately 13.1 million ounces at prevailing prices. MAS Managing Director Ravi Menon stated in Singapore's November 21 Monetary Policy Statement press conference that diversification of reserve assets remains a strategic priority given evolving international monetary architecture, but declined to specify which metals comprised the increased holdings. However, MAS December 2025 annual report, released December 16, disclosed that 68.7% of their other monetary metals now consists of physically allocated silver meeting London Good Delivery Standards, language that precisely matches the BIS Tier 1 classification criteria. Add those three central banks together: Switzerland, 17.6 MAs, Saudi Arabia, 22.3 MAs, Singapore, 13.1 MAs, equals 53 million ounces worth approximately $3.61 billion. But the IMF data shows total central bank accumulation of 94.6 million ounces from January through November 2025, meaning approximately 41.6 million ounces came from undisclosed buyers, likely including central banks that don't publish monthly reserve disclosures, such as China's People's Bank, India's Reserve Bank, or various Middle Eastern monetary authorities. The solar silver trap just closed at $72 per ounce. The 30-year supply buffer that once cushioned this market has been compressed into 14 months of industrial panic, central bank accumulation, and inventory extinction. Everyone who runs the numbers sees the same mathematical inevitability. The only variable is whether you position before or after March 2026 forces that inevitability into public consciousness and reprices silver to reflect physical reality instead of fractional reserve fantasy. Subscribe for more Economy Today that explains today's economy.